Good morning and welcome to today's webcast, Q3 Investing Insights, Macro and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in the slide deck and handouts widget. And with that, I'll turn it over to Dominic to get us started.
Thanks, Emily. Good morning, everyone, and welcome to the third quarter installment of Macro and Markets. I'm Dominic Cellitti, Senior Financial Advisor with Moss Adams Wealth Advisors, and I'm joined as always by our Chief Investment Officer, Michelle Walker. So last time we were here, we were in a pretty nasty downturn in the markets. Felt like the floor was kind of falling out from beneath us with historic tariff announcements day after day, along with fear-mongering headlines driving market moves and a rapidly weakening dollar. Now, fast forward to where we're at today, and the market is course-corrected and some. Now, all the major stock indices and the broader bond market even are up on the year, and that rally appears to now be broadening. So to kick us off, Michelle, can you walk us through some of the specifics around the last quarter and what got us to today?
Yeah, Dominic. So the second quarter of 2025, as we all pretty much know, was quite volatile. The period was impacted by just a barrage of uncertainties, including chaotic tariff policies, heightened geopolitical tensions, ongoing uncertainty surrounding budget and tax negotiations, and persistent concerns about the deficit and inflation. And despite all of these challenges, the market staged a pretty remarkable turnaround, rebounding from bear market territory in early April to end the quarter at all-time highs. The S&P 500 delivered a double-digit gain for the quarter following the tariff scare and was up more than 11% for the quarter. And this marked the best quarterly performance since 2020. The Nasdaq also reached historic highs in Q2 as technology and AI-related companies dominated U.S. returns. Defensive, quality-oriented stocks and healthcare stocks notably lagged. Fixed income markets also experienced considerable turbulence during the quarter, driven by shifting global capital flows, speculation regarding Federal Reserve policy, and uncertainty about the fiscal outlook, including the potential for tariff-related inflation. But nevertheless, the broad U.S. bond index delivered its second straight quarterly gain, largely due to June's strong performance, and the Bloomberg U.S. Bond A closed up 1.2% for the quarter, lifting its year-to-date return to 4%. So let's just say it's been a wild ride. Dominic, can you speak to the tariff scare and all the worries about a flight from U.S. exceptionalism?
Yeah, I'd love to. So let's go back to early April when it felt like all hell was breaking loose. Not just for stocks, but also interest rates and the U.S. dollar. That month, the S&P 500 briefly entered bear market territory as concerns over the scale of tariffs announced by the president on Liberation Day triggered panic selling. The index fell nearly 20% from its highs reached just 2 months prior, mostly driven by fears that much higher than expected tariffs would lead the economy into a recession. Following that, corporate earnings reports and forward guidance became choose your own adventure announcements with no real clear path ahead for investors, executives, and business owners alike. Now, fast forward a week to April 9th. The administration essentially saves itself by announcing a suspension of the most severe tariffs. This sparks a dramatic 9% rally in a single session, which is the largest daily advance since October 2008 and the 8th largest on record. So I'm going to pause here because this day is a prime example of how timing the market can go so extremely wrong. If you had panicked and exited the market prior to this to sit on the sidelines or wait for the dust to settle, etc., this is the epitome of why staying invested is what pays off. Some of the best single-day returns are clustered around some of the worst. And when the market feels the worst, you get these coiled spring-like reactions. If you miss that, the market's not going to let you back in. So as we see here on the slide, historically speaking, intra-year declines are normal. The average is more than 14%. And you may notice that you never finish the year at the low. So after April 9th, what do you do if you exited the market? You have to wait and hope it pulls back more? What happens if it doesn't? Even with a 20% pullback from where we're at today, you'd be buying back in higher than the lows. And this is unfortunately why a quarter of those exit the market, go to cash, never make it back in. The market is relentless and it's not going to wait for you. So that relentlessness is exactly what we saw continue. So we had positive momentum continuing through May and June. The administration began reporting progress on trade deals, particularly with UK, China, and Vietnam. Now the range of potential outcomes begins to narrow, and it's in a more favorable direction. The tariff announcement and environment becomes more balanced compared to Liberation Day announcement being essentially a high watermark. The VIX, which is a measurement of short-term volatility, spiked to levels not seen since COVID in April. And now it's receded to normal levels by the end of the quarter, even up till today. So I'm going to pause here again on volatility. Last time I talked about avoiding major adjustments during high volatility. Corrections, bear markets, pullbacks, and any type of high volatility period can feel extremely uneasy. I get it, but it's not the time to make major rebalances. Even more so when there's no fundamental adjustment in earnings or policy, simply being driven by headlines. So now we've moved into a more normal VIX. And if you want to consider adjusting your long-term allocation, if that volatility was just too much for you, this would be the time. Analyze what that's going to do to your long-term returns and your financial plan. And if you can live with that, go ahead. But in summary, after the whirlwind April market, we moved into a much friendlier market across the board up until today. Equities have rebounded and credit spreads in the fixed income market have tightened, reflecting a shift from recession fears to expectations of continued economic expansion. So what about the so-called end of U.S. exceptionalism? In April, we saw headlines of the death of America's leadership in the global economy, the risk of the dollar falling from its rightful usage, and investors of all sizes and geographies dumping U.S. assets. Now, there might have been a falter, but now we actually have the data to see if the headlines were true, and it turns out they couldn't be further from the truth. Yes, in April, foreigners were net sellers of U.S. assets by about $25 billion. The 2 months prior, they'd averaged about $125 billion in purchases. So what happens the following month in May? They come back and purchase $325 billion in U.S. assets. So in 1 month, they came back and made up for more than what they dumped the prior month. Yes, the dollar is also weakened. It's at levels last seen just a couple of years ago. And mind you, that's after a historical run the past 2 to 3 years. Now we've actually untethered from interest rate differentials, which means from a technical aspect, the dollar re-strengthening in the short term is the most likely path. So all this to say, the U.S. has what I would say is the most trusted institutions, businesses, and assets in the world. And I'm sure there's been some superficial damage with some of the certain trade tactics, but I by no means believe U.S. exceptionalism is dead. So, Michelle, with that being said, clarity on tariffs certainly had an impact on markets, but there were a few other major drivers, were there not?
Yeah, there definitely were, and a big one was corporate earnings. We had a surprisingly robust earnings season for Q2, with 78% of S&P 500 companies reporting results that exceeded analyst expectations. And while investors have kind of braced for disappointing profit forecasts, looking further out, those concerns just didn't materialize. I mean, most notably, businesses maintained a strong pace of planned CapEx expenditures despite ever-changing tariff headlines. And this was especially evident in sectors focused on AI, where many companies signaled a commitment to ongoing operations and increased investment in AI to drive efficiency and safeguard their margins. So despite all the uncertainty, there's been plenty, the global race to invest in AI infrastructure seems to be full steam ahead in 2025, driven by both US tech giants and major sovereign funds. So looking at this next slide, US hyperscalers such as Google, Amazon, Microsoft, Meta, and Oracle have all announced billions of dollars in planned and new investments in data centers and AI infrastructure. In total, just these five are expected to spend over $300 billion in 2025. These firms are putting major emphasis on not just compute and networking, but also on securing reliable energy. Data center power needs are at the forefront of all the conversations we're hearing, with multi-billion-dollar plans for grid upgrades and the build-out of alternative power sourcing. And the investments are not just coming from these US-based technology powerhouses. We're seeing it everywhere. In Saudi Arabia, the government and its public investment fund, PIF, recently launched new multi-billion-dollar funds to establish regional cloud and AI infrastructure, often through joint ventures with US and Asian firms. In Japan, there's been significant public and private sector investment to attract global cloud providers, invest in semiconductor manufacturing, and offer incentives for infrastructure partnerships, all aiming to sustain Japan's competitiveness in global AI. And the list goes on and on. Alibaba in China and French-based Iliad announced enormous AI and data center investments, and other governments, including the EU, UAE, and Singapore, have all rolled out national AI compute and data programs. So suffice it to say, the race is on and nobody wants to fall behind. So as always, we're here to talk about investing. And when considering the long-term secular investment themes related to all of this CapEx activity, we favor sectors in the public markets such as semiconductors, information technology, cybersecurity, US manufacturing, and communication services. But among all of the investment themes, few are as compelling as this extraordinary and urgent demand for power driven by the rapid expansion of all this technology. AI models require enormous computational resources. Modern AI models, especially those used for generative AI and large-scale language processing, are trained and deployed in specialized data centers containing thousands of high-powered graphic processing units, or GPUs. And these GPUs consume dramatically more electricity than the CPUs found in traditional data centers. By 2035, the power demand from modern AI data centers in the US is projected to grow more than 30-fold. And this growth means data centers could account for nearly half of US electricity demand growth between now and 2030, and as much as 12% of all US electricity consumption by 2028. So of course, failure to meet these energy needs risks slowing AI advancements in the US, potentially ceding technological and economic leadership to other countries who are rapidly expanding their own power sectors. And as a result, and not a surprise, industry, utilities, and policymakers are all now really prioritizing upgrades to the grid, accelerating new power generation, including renewables and natural gas and nuclear, and forging partnerships to ensure sufficient, reliable, and sustainable electricity is available to support this ongoing US technology revolution. In our public market portfolios, we're expressing this view through owning the utility sector, but where we see the most compelling infrastructure opportunities is really in the private markets. Dominic, what are we seeing in the private markets in general and as it relates to this unique opportunity in power generation infrastructure?
Yeah, so to start out, let's talk about why we looked at private markets in the first place. In the past, we looked at the return and correlation slide showing excess returns and less correlation to public assets. So I'm going to try something different this time for those who've been with us in the past to demonstrate the value here. As you see on the slide, the top left, the number of public companies has been shrinking and the average public company size has been growing. At the bottom left, you see that the average age a company goes public and the company's size have both increased. To me, that clearly tells us that first, there's an opportunity set outside of the public markets that when accessed adds to diversification. And second, Those that are seeking a public exit are growing and creating value within the private market much longer versus historically having done that in the small cap space and mid cap space in the public side. Now, the second point I want to make before we get into specific opportunities we like, in general, the average retail investor's exposure to private investments rounds to zero, but that's changing. Technology and democratization platforms are giving investors access to previously inaccessible markets. We're definitely still in the early innings of this. The average high net worth investor has 2% exposure, as you can see, versus the average family office and institution being closer to 20%. Obviously, a big component of this is understanding risk tolerance and liquidity needs, but a good advisory team should be able to define those for you and assess how much and how frequently you can access private investments. Now, on to some opportunities in the infrastructure space. We've talked about this a bit before, and Michelle kind of gave you a more specific breakdown of the need here, but I believe it's a huge opportunity given the demand in both updating our existing infrastructure assets and additionally with the new development and evolution of new assets being driven by energy demand in areas like data centers. So on the chart here, you see that there's about $4.5 trillion in planned funding for infrastructure build out over the next 9 years. But that's not going to cover it. There's a shortfall, an additional need for another 3.3 trillion to keep up with existing demand in the various infrastructure asset types. Then on the right, you can see that this trend is not going anywhere over the next 2 decades. Lots of tailwinds here, one of them being the thematic approach to energy demand and power generation. On the next slide, you see the vacancy rate for data centers trending lower and the power absorption trending higher. Bottom line, the drive for compute power and diversification of energy supply for this sector is an attractive opportunity in the evolution of AI amongst other technologically driven sectors in the market. Tack onto that some favorable tax policies for capital expenditures, along with a spending race by major corporations, and it's certainly a wave I would want to ride. The other area that I'd like to discuss in private markets would be private equity secondaries. There's no slide for this, but for those unfamiliar with PE secondaries, in short, an investor or fund manager may need to liquidate a private holding prior to an expected exit. So as the seller, this is what liquidity planning is meant to prevent. So it's usually done because of a balancing mandate for an institution or unplanned need for cash. As a buyer, though, this is a great opportunity. Pick up something at a steep discount because someone else is being forced to sell. As Michelle will talk about shortly, private asset managers are gearing up for exit, but we've been in a stalled pattern for much longer than expected. So using this opportunity to pick up some good companies for pennies on the dollar is a great opportunity, in my opinion. Last piece here on privates, something I mention every time. What you see here is the dispersion in returns for each asset class. On the public side on the left, your expected return from the best and worst stock manager is going to be relatively small. You're going to essentially get the same return regardless of who you're investing with. On the private side, it's absolutely not the story. Selecting the appropriate manager is key to building out expected and outsized returns and having the ability to repeat that success over multiple market cycles. So that's our take on private investment space for right now. Let's broaden this out a bit. Michelle, what's going on in the greater economy?
Sure, yeah. So despite all the headwinds we've talked about, there is continued support for a resilient U.S. macro backdrop. So the S&P Global U.S. Manufacturing Purchasing Managers Index for June registered at a very strong 52.9. So any indicator on purchasing manager surveys over 50 signals ongoing growth. And just yesterday, we received the flash PMI estimate, or the early read for July, which rose even more to 54.6, signaling really strong expansion in the overall economy, and it had particular strength in the services sector. So looking at inflation, though still above the Fed's target of 2%, it has been on a downward trajectory, with the annualized consumer price index, or the CPI, for May coming in at a tepid 2.4%. Of course, there is expectations that we could see that heat up later in the year as tariffs do trickle through the system, and more on that later. The unemployment picture still looks pretty good. It's remained stable, fluctuating between 4% and 4.2% from January to June. And initial jobless claims have fallen for 6 straight weeks, with the 4-week moving average of initial claims hitting a 3-month low just yesterday. And we're just starting this earnings season, but so far so good. It has been strong with 83% of reportings beating consensus EPS or earnings per share expectations. And as Dominic mentioned, there's also been a pickup in high profile M&A with Synovus and Pinnacle combining in an all-stock deal last week worth $8.6 billion. And just this morning, the announcement that Union Pacific and Northern Southern are going to have a merger in the rail space. So Blackstone, a big private investment manager, reported earnings last week and commented that the deal environment is really starting to look good. And they noted that they're seeing the busiest pipeline of potential IPOs since 2021. Okay, looking at this next slide, when looking at GDP, the headline level of US real GDP did contract at an annualized rate of 0.5% in the first quarter. However, that was really largely due to a surge in imports as businesses and consumers sought to really stockpile goods ahead of anticipated tariff increases. So imports, which are actually a subtraction when calculating GDP, as you can see here, created a pretty big drag of roughly 5%. So this negative print for Q1 was really largely looked through. Now we're going to get the Q2 GDP print this week later on, I think on Thursday, and it's expected to be around 1.5%. Now that is slower than last year, but still pretty respectable growth considering the uncertainty that we've faced and businesses have faced. So when considering GDP and what that's going to look like, it's important to recognize that the US economy is predominantly consumer driven, with approximately 68% of GDP derived from consumption. So we always maintain a close watch on the consumer and their behavior and trends. So Dominic, what are you seeing when it comes to the consumer?
Yeah, so time for our usual check-in on the backbone of the U.S. economy. And luckily, the sentiment tide is turning. The consumer's talking a bit more positively, which is more in line with what they've been doing, and that's spending, as always. So let's look at the consumer balance sheet first. I still don't see any major concerns at this point. Leverage is still in a manageable range, as we see on the left side, from both the types of assets being leveraged and the relative cost to service that debt. Then at the top right here, you can see the average consumer is still able to meet their obligations, and it's well below the long-term trend as a proportion of their income. So on the whole, they're not stretched. What looks like a shock, though, bottom right of the slide, we're looking at delinquencies. Look at that orange line. That's student loans in delinquency, spiking out of nowhere, right? Not really. Amid the pandemic, we saw an equivalent drop about 4 years ago, as you can see. This type of debt has just been on pause from reporting to credit bureaus for about 4 years. Now, all we see is the change in policy reversing and these delinquencies being reported again. Now, if that trend continues, it could be impactful. But right now, just resuming some data gathering normalcy. Some other positive signs, credit cards and autos continue to move sideways. Mortgages, on the other hand, continue to trend upward. This is something I've mentioned last time to keep an eye on. I still believe you're seeing some dependency on buyers that were hoping for rates to fall much faster than they have, and they stretched their budget a bit on a home purchase previously. So rate cuts would certainly be welcome to this group, along with a ton of potential home buyers currently on the sidelines. Looking at unemployment and wages, nothing alarming. Unemployment is below its long-term average of about 6%. We have not seen major layoffs from any tariff-driven cost cutting or AI moving workers out of traditional jobs. Wages continue to grow at a modest clip, outpacing inflation, which is the sweet spot we want to be in. But how are we feeling? Better, but still not great. We've had a big jump off the recent sentiment lows, but still below the long-term average. Once again, I'm not sure we'll ever return above the average, just given the popularity of negative sentiment and how bipartisan our takes on the economy have become. So let's move on to where we stand on tariffs for the moment. Following the initial shock from higher than expected tariff rates disclosed on Liberation Day, the market's become pretty desensitized to any headlines. Several deals have also been solidified since quarter end, including important ones in Japan and Europe just this past weekend, and the administration was in talks with China today even. So it seems like the 10 to 15% level will be our status quo. It's a lot higher than the previous long-term trend of 2 to 3%, but well off the threatened levels in April. As a reminder, tariffs are a tax on goods. The US is a service-driven economy. So fortunately, services inflation has been declining. Service-driven economy is also why we likely won't see such deep and broad recessions as we have in the past, because we have the ability overall to pivot a lot more than we have in previous generations. So in our view, any inflation from tariffs will be a one-time shift up in prices, and it won't manifest to persistent inflation. Tariffs immediately raise the price level of affected goods, but do not by themselves cause prices to keep rising year after year. You would need additional fiscal stimulus to create excess demand to continually drive prices up higher and higher. So we believe the market will absorb the blunt force of this reset either as a one-time price increase, a hit to corporate margins, or probably a combination of both, which is the most likely scenario. Bottom line, the rate of change shouldn't move meaningfully higher long-term from tariffs alone.
Yeah, so Dominic, speaking of the potential for tariffs to lead to inflation, even if it's not persistent, there's been a lot of conversation about the Fed's dual mandate related to stable prices being balanced against full employment. And clearly the administration has a view on what they would like the Federal Reserve to do, quite vocal. What are your thoughts here?
Yeah, so the Fed's essentially still been on pause since December. The June meeting, they unanimously voted to maintain the rate target range of 4.25 to 4.5, where it stands today. This is the fourth consecutive meeting with no change. And the FOMC emphasized cautious approach to future rate adjustments, indicating that they're going to depend on data, particularly inflation and labor market conditions. So far, they've stuck to their word. And even though inflation data has trended the right direction, the uncertainty on our tariff policy, which is leading to a decoupling from that trend, needs to be seen in order to maintain the reliance on data. So they're in a sticky spot. The Fed is meeting as we speak, and we don't expect them to cut this time around. But we could see several dissents from several governors, as the group has lost some cohesiveness over the past few meetings, considering recent inflation readings and the overall delta between the restrictive current Fed funds rate and their target rate. But this also could be driven by some governors vying to be Chair Powell's replacement come next spring. So in short, I think the Fed is in a tough spot. Unemployment's well below historic levels, and inflation so far has been kept in check. In my opinion, the housing market needs rate cuts, though. And small businesses and lower-end consumers are really feeling the impact of higher rates much more than corporations. And I don't think cutting rates will really have that much of a detrimental heating up of the economy. So, some more recent news, Michelle. The One Big Beautiful Bill Act passed and was signed into law by President Trump on July 4th. Can you talk us through some of the key provisions there and what that impact might be on the market?
Sure. Yeah, so as Dominic mentioned, after much wrangling, they did get that bill signed. For the major provisions, the bill extended the 2017 Tax Cuts and Jobs Act, or the TCJA. It introduces deductions for tips, overtime, and auto loan interest, raises the state and local tax SALT deduction cap from $10,000 to $40,000, increases the estate tax exemption to $15 million, establishes savings accounts for newborns, expands the child tax credit, and it introduces a senior tax credit. And importantly to corporations in the market, it revives critical corporate tax provisions such as R&D expensing, bonus depreciation, and interest deductions for businesses featured in the 2017 Act. For spending additions, it includes an allocation of $170 billion to border security, including enhanced enforcement and deportations. Allocates $150 billion to defense. As far as spending cuts, it implements $1.2 trillion in Medicaid cuts and it introduces additional work requirements for SNAP benefits. Additionally, it phases out over time certain renewable and energy tax credits that were established in the Inflation Reduction Act. And finally, it raises the debt ceiling by $5 trillion. So what does all this mean for the markets and the economy? Well, on the positive side, the bill could provide a meaningful tailwind for economic activity. Provisions such as accelerated depreciation, increased incentives for capital expenditure, and further deregulation are likely to stimulate the private sector investment. As it relates to growth, many of these new tax cuts take effect retroactively to January 1st, 2025, so taxpayers could see income tax refunds early in 2026, boosting growth and consumption. As for profits, revived corporate tax breaks could boost profits, offsetting some of the increased costs from tariffs. In fact, on recent earnings calls, we have already heard some companies citing these enacted legislations, like especially certain new equipment, immediate deductibility, that's already boosting their cash flows. On the less positive front, of course, growth in consumption driven by the tax bill in conjunction with tariff costs could keep inflation somewhat elevated. The wild card, of course, is if productivity gains from AI may offset that inflationary impulse. For jobs, increased border security and deportations could reduce the labor supply, which might mean wage pressure going forward. Again, the impacts of AI are sort of unknown on what that will mean for productivity in the labor force. And finally, the OBBA is expected to increase the deficit. Most recent estimates are around 3.4 trillion. So to kind of wrap this all up, despite a chaotic tariff rollout, geopolitical flare-ups, and a bumpy ride toward a final tax plan, the market has really climbed that so-called wall of worry. While tariffs and tariff uncertainty may slow U.S. economic growth in the near term, we do foresee a rebound in 2026 driven by increased clarity on trade policy, tax reductions, deregulation, ongoing AI investment, and more accommodative fiscal policy. And as for portfolio implications, we do continue to believe diversification remains a cornerstone of a resilient portfolio. As you all know, core bonds have played a stabilizing role this year and allowed a lot of investors to weather a significant drawdown to start the year. And as Dominic described, private investments continue to be a valuable component in a portfolio in managing volatility and enhancing long-term portfolio resilience. So with that, we're at our time. Just want to thank everyone for joining us today. Appreciate your time.
All right. Thank you, Michelle and Dominic, for a great presentation today. If you have questions for our presenters, you may reach out to them directly in the speaker bio widget. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance upward. Thank you for joining us, and we hope you'll join us again next time.
Thank you.